Welcome to 5x series, company number 5, TOST Inc. In this video, I'm going to talk about whether TOST can do a 5x by 2030 or not. In doing so, I will cover TOST's business model, financials, and finally I'll do a valuation. And I will also tell you whether I'm buying this stock or not. Let's first look at its business model. As you can see on the screen, TOST operates a cloud-based digital technology platform for the restaurant industry in the US and Ireland. This company offers TOST POS, which is a point of sales tool. They also do TOST invoicing that allows restaurants to send invoices and collect payment. There is TOST mobile order and pay, which allows guests to scan a QR code to browse the menu, order and pay from mobile. And there's also kitchen display system software that connects the house with the kitchen staff, and also multi-location management so far. So there are multiple software services that TOST offers to the restaurant industry. As you can see on the screen, restaurants are complex businesses. You can see there are a lot of activities involved in the restaurant business, right from the integrated payments, loans, banking service. There is takeout, delivery. There's also employee benefits, insurance, recruiting. There is reporting, accounting. Also, there is waitlist reservations, table management. There is kitchen operations. Obviously, there's point of sale. Also, we need to have websites, marketing, loyalty, and gift cards. So there are a lot of activities involved in the complex restaurants business, and TOST wants to cater to all of this, and they want to become a single point solution for the restaurant business. So how does TOST make money? As you can see on the screen, they have recurring revenue, which is coming from subscription services as well as financial technology solutions. And there's also one-time revenue with hardware sales and some professional services. In summary, TOST is a software business that's focusing on restaurant industry. There's nothing special about this company. They're operating in a very, very competitive industry and the margins are very low. We'll see that when we do the valuation. Let's now move on to the financials. As you can see on the screen, at close to $17 stock price, their market cap is about $9 billion. In the past 12 months, they made a revenue of about $3.6 billion. So that's a price to sales of about 3, which looks cheap, but it's not cheap because the margins on this $3.6 billion of revenue are razor thin. So price to sales is not a good metric. With respect to revenue growth, this company grew its revenue by over 50% on an average in the past 6 quarters. So the revenue growth is incredible. Even when you look into the shares outstanding, the dilution is not too significant. So there is some dilution, but it's not too significant. So that's good news. When you look into the gross profit, that's what worries me. It's about 20% or low. When your gross profit is 20% or low, the net profit margin would be at best in high single digits, right? So that definitely worries me. Let's look at TOST's most recent income statement to get an idea of how they are doing. As you can see on the screen, in the most recent quarter, they made close to $1 billion of revenue. The gross profit is $226 million. That's about 20% gross margin, like I said, which is low for a software business. They made a loss from operations, about $59 million of loss. And with respect to number of outstanding shares, they diluted the shareholders by 4% year over year. Stock-based compensation in the most recent quarter is about $71 million. So that's about 7% of the total revenue, which is not too bad. When I look into the balance sheet, this company has close to $1 billion of cash, cash equivalents, and marketable securities, and the debt is not significant. So the balance sheet is in a very good position. Let's look at their outlook. For the fourth quarter of 2023, they're saying they can make revenue in the range of $1 billion, right? So in Q3 of 2023, they made $1 billion. And in Q4 of 2023, they're still saying they will make $1 billion. So there is no growth quarter to quarter, but it represents 22% year over year growth. For TOST, which has been growing more than 40% on an average year over year until last quarter, suddenly if they're saying 22% year over year growth, a lot of investors got worried that the growth story is ending, and therefore the stock fell significantly when they reported their recent quarter results. For the full year ending 2023 December 31st, they're saying the revenue would be about $3.8 billion. So that represents 40% year over year growth. Before we move on to the valuation, I want to clarify that this is not financial advice. I'm not qualified to give any financial advice. I'm simply recording my thoughts about Toast. This valuation is for 2030, that is 7 years out. As you can see on the screen, in 2023, I think there's a typo there. That's actually 2023 revenue of $3.8 billion. I'm assuming an estimated growth rate of 17.5% for the next 7 years. Note that the total addressable market for Toast is significantly high. They are operating in the restaurant industry, right? And they also have multiple services. For example, if there's a company that's taking one of their service for now, they can always cross-sell other services to that company, right? And also, as a whole, they're increasing their number of customers as well. So I think 17.5% is possible for this company to grow on an average in the next 7 years to make about $11.75 billion of revenue in 2030. With respect to net profit margin, currently their gross margin is 20%. So I can assume high single digit net profit margin at best. But I'm assuming 10% net profit margin because by 2030, I'm assuming that they'll get a lot of scale and a lot of efficiency built into their operations to get this 10% net profit margin. If you think they can get less than this, please assume that number. But for me, 10% seems reasonable. With that, they'll make close to $1.18 billion of net income in 2030. For a company that's growing 17.5% consistently on an average for the next 7 years and have a 10% net profit margin, I can give a multiple of 30. With that, the market cap in 2030 would be about $35 billion. With respect to the number of outstanding shares, currently they have close to 531 million outstanding shares. And I'm assuming 2% dilution until 2028. And after that, I'm assuming that they'll become profitable and not dilute the shareholders. So with that, they will have 591 million outstanding shares in 2030. When I divide the market cap of $35 billion with 591 million outstanding shares, I get a stock price of $60. Currently, they're at $16.8, right? So that's about 255% gain in 7 years, or a 3.5x in 7 years. When I look into these assumptions, I think they are reasonable. I don't think they are unachievable by Toast. So in my opinion, Toast can do a 3.5x by 2030, which is an incredible gain if you think about it. But obviously there are risks. They are operating in a very competitive industry. The margins are razor thin. Now let me tell you what I'm doing with this stock. For my personal journey, I always look at 5 years out, and if I see a compelling gain, then I invest. So for 2028, as you can see on the screen, for 2023 revenue, I'm assuming $3.8 billion. The estimated growth rate that I'm assuming is 20% year over year for the next 5 years, to let them make about $9.5 billion of revenue by 2028. I'm assuming a net profit margin of 7.5% because their gross margin is 20%. It's hard to get double-digit net profit margin for this company. So I'm assuming 7.5%. With a 7.5% net profit margin, they can make about $710 million of net income in 2028. With a multiple of 25, this company would be worth about $17 billion. I'm going to keep the dilution same. When I divide the $17 billion of market cap with 591 million outstanding shares, I get a stock price of $30. Currently, they are at $16.8, right? So that's about 79% gain in 5 years, which will definitely beat the index. So 80% gain in 5 years is compelling to me, which is why I bought about 50 shares of Toast today. The reason why I did not buy more is because I want to investigate more into their gross margin, why it is so less, because one of their competitors, Lightspeed, has 40% gross margin. Initially, I thought Toast is growing much faster, probably because they are offering their solutions for a huge discount, which is why their gross margin is low. But it seems like that's not true. They're still offering their products for a much higher price than their competitors and still getting 20% gross margin. So that makes me worried. That's why I want to dig a little bit more into their gross margins on what is happening. I listened to their CEO's call and I did not get any good information about why the gross margin is so low. But I'm going to continue follow this company's earnings in the coming future, and I will invest in this company if I think that the gross margin is going to improve in the coming future. In conclusion, this is not a 5x stock in 7 years. The best they can do is 3.5x in my opinion. Again, this is not financial advice. For my personal journey, I bought about 50 shares and I posted on YouTube community. As I find out more information about the gross margin, I'm going to share it with you all. If I buy more, I'm going to share it with you all in the YouTube community posts as well. Let me know your thoughts in the comments. Thank you so much for watching.